Hello traders, Corey Mitchell here. I have been getting a lot of questions, seeing a lot of comments on oil today. Pretty unprecedented action we're seeing today due to a number of things. We have a oversupply of oil. We have less demand because of quarantines around the world due to coronavirus. And then we also have a shortage of storage. So there's tankers that have been just filled up with oil and are just sitting, waiting to get rid of it. And most people in the oil industry have no more places to store oil. So the oil contract, I don't trade oil very often, so these are delayed quotes by a couple minutes. And I have live quotes in my Forex broker, but on TradingView here, I just use the delayed quotes, or you can also look up a CFD if you want real-time quotes. But I pulled up the actual futures exchange on NYMEX just to show you the difference in a couple contracts here. So May, these are actually negative prices. And I don't know, I'd have to go on the history books, but I don't think we've had negative prices before. And so what happened is when this contract expires, it means anyone who owns this contract is willing to take delivery of the crude oil that they bought. So most of the times when us as speculative traders just jump into one of these contracts, we're buying it or selling it just to make money on the price difference in the actual contract. But the actual contract itself is based on whatever price someone sold at. That's the price. If they actually want to sell oil, that's the price they've locked in to sell oil at. If someone wants to buy oil, they could have bought at any point in this contract, and that's the price they locked in to buy oil at. So this unloading is people who do not actually want to take delivery to buy the oil. Like, they don't want the physical delivery, that oil coming to them, because they have no place to put it. And retail traders, if there were still some stuck in here, hopefully not, they should have transferred over to the June contract, which isn't expiring right away. They face, if they hold this right to expiry, they face having to take delivery of physical oil. And there's strict exchange requirements. Me and my friends were joking, of course, that you could fill up your backyard with oil that they're paying you $30 to take off their hands. You don't even have to pay for the oil. They're going to pay you to take it. And then you could sell a June contract right now, which is trading at $21. So you can see there's no major decline in June yet. I mean, it's still off quite a bit today. I think it's down, 16%. So quite a drop today, but nothing like into negative territories that we're seeing on the May contract. So technically, if you had storage capacity, you could have bought oil contracts at negative $30 or negative $5, immediately sold them on the June contract. So you would have bought oil, you would have had to take physical delivery, store them. Then you sell a June contract, which means you're selling them to someone else, and they have to come and buy them, and they're buying them off of you. They'll have to worry about storing them the next month, and you could have locked yourself in a huge profit for 1 month of storage capacity. That's basically how much storage is costing right now. Is the difference between what the May contract's trading at, around negative $20 right now, and June plus $20. So an incredible, unprecedented move, really. But you can see it's just pretty much a one-day anomaly. If you look at the June contracts and you keep going out, oil's trading at $20. If you go out to October, I think it's around 30. If you go into December, it's around 35. So it's a one-day event just due to this kind of convergence of events happening right now, where you have lower demand, an increase in supply because of that, when the Saudis and the Russians just decided not to cut a month or so ago and just kept pumping oil. And then you also just have this shortage of storage space. So seeing a pretty interesting move here, and I knew lots of people would be wondering what's going on. There are if you're wondering, can I store it in my backyard? No, you cannot. There are specific exchange requirements that don't allow you to do that. So you need to basically maintain the integrity of exchange traded oil, which is, I'm just trying to pull it up here. So here is, you can look up chapter 200, NYMEX rulebook, and this basically explains what has to happen for oil to be exchange quality. So yes, you could buy oil today at $20 or negative 18, negative $20. So you're getting paid $20 to buy oil. And if you sell that contract next month, you'd lock in that profit. But in order to sell it on the June contract, it still needs to be exchange quality. And there's a whole host of things that have to happen in order to maintain the integrity of that oil. So if you were to take delivery of it, assuming you wanted to, these are basically the protocols that have to be followed. So no one that I know of as a retail trader has the capacity to do this. So it's purely fanciful thinking for the most part, but I know it was going on in a lot of conversations today, like, let's store it in our backyard, let's, fill up all our gas tanks, and maybe we'll see negative gasoline prices, stuff like that. So it was, wow, there were definitely people that are getting extremely hurt in this. It was also definitely some fun conversations going on, just because when something like this happens, you don't really quite know how to react. So you try to find the light in it, and yeah, so I thought I'd shed a little bit of light on what was going on between these two contracts and why this one is trading in negative territory. To be honest, I didn't know. I joked with a friend the other day. I said we could see negative oil prices where someone has a bunch of oil they're sitting on and they start paying people to take it away. But to be honest, I didn't actually know if prices could actually go negative on the exchange. So that was something very interesting to me. And when I saw it tick below zero, that was, a very interesting moment. And then the fact that we plunged so far below it. So an unprecedented day. Back to normal trading tomorrow. This will be off most people's radar. Interestingly, on a currency perspective, the Canadian dollar did not move very much. So you can kind of see it's a bit of a, like this is a 4-hour chart of the Canadian dollar yen. The Canadian dollar tends to move with oil prices. The yen moves against it because Canada is an oil exporter. Japan is an oil importer. So if this was a really sustained move, you would think you would see a massive sell-off in the Canadian dollar, because this would hurt their economy if prices were actually near zero or negative. But it's just looking like it's just a one-day event. We'll see what happens with the June contract. Who knows if these things don't get fixed up in the next month, if demand doesn't increase, if supply doesn't drop, although it is supposed to, and the storage situation doesn't get cleared up, we could see a similar situation in June. Whether it's as extreme or not, we'll see. But right now, seeing a pretty solid Canadian dollar, not moving too much, at least on today's action, down a little bit, but nothing like what we saw in the oil contract. So we'll see. That kind of gives a bit of assurance at the moment that what's happening is pretty much isolated to that one contract at the moment. The May contract was expiring right away, and people are just panicking to get out of it because they don't want to take physical delivery of oil. They have nowhere to put it. So that's the explanation. Until next time, happy trading.